How wary are you of the run-up we've seen, particularly in developed market equities this year?
We remain fundamentally positive on the equity markets for the remaining part of the year and into 2014. It is fair to say that we would like to see some progress on earnings growth before we can see the markets going higher from here. So we took a little bit of a pause and reduced slightly our equity exposure, went from an overweight to neutral. But we fundamentally remain positive on the asset class and would add on any pullback in emerging market and in developed equities.
Where is the growth that you're looking for going to come from?
Well, that's a difficult question. The world is a better world at the moment. The US economy is doing quite well. China has stabilized. So we're looking at those two growth engines to be really the contributors of growth going forward.
So a slowdown, in particular in Europe, you think, on the equity side next year. Are you worried about the deflationary story that is clearly doing the rounds right now?
Well, Europe remains the sick man of the world, I would say. A little bit the demographic situation, a little bit the fact that money is not going around and the money multiplier remains very low. However, there are signs of stabilization. And again, the US market and Asia with China stabilizing, which would inevitably benefit Europe. There is also another factor which we may benefit from in 2014, and that is a weaker euro, if that ever materializes.
Emerging equities, though, you're looking to now. Where in particular? What are the buys now?
Well, Asia remains a very interesting opportunity, even because demographics on one side in Southeast Asia in particular, but also China, which has stabilized. Very interesting reform plan from the latest meeting of the authorities.
Interesting in what regard? Interesting, i.e. positive for the investor in China?
Well, positive because we are looking at the rebalancing of the economy from infrastructure to consumer demand. Now, this is very ambitious and it'll take a long time to achieve, but ultimately, Chinese households having more money left in their pockets is going to be good for the world. Think about how much they can import from abroad. Think how much money they can invest in the local equity markets. So, fundamentally a more healthy and balanced economy. Again, it's not going to happen tomorrow, but we are going in the right direction.
What about emerging currencies? On the back of the positive play you feel for emerging equities, what about the counterparts, the currency counterparts?
Well, I think emerging currencies is a basket where you have got weak macroeconomics in certain countries and very strong macro features in other countries. I know that all the emerging currencies have been extremely volatile, particularly during the summer period, but I would think that going forward the market will make a difference between the Indonesia on one side, some of the countries with weak current accounts, and the strong currencies on the other side. So there has been a lot of volatility. The psyche of a lot of investors has been hit, but probably a more rational market going forward. I
want to finish up by coming back over this side of the world and the UK. I know you're a little bit wary of the growth and the value story in the UK. What is the UK trade, if there was one for you in 2014?
Well, first of all, talking about markets, the UK market remains a multinational market. Take the FTSE 100. It's a market which is populated by big companies doing a lot of business internationally. So a better tone in emerging markets will be very good for large caps in this country. On top of that, you've got the real estate renaissance in the UK. The property market is doing extremely well. And definitely this is going to have an impact also on smaller caps and smaller firms.
Okay, Marino Valensise from Bearing Asset Management, many thanks for talking with us. All our interviews from the Reuters Investment Summit you can find on the Insider platform. That is it from me. I'm Axel Threlfall. This is Reuters.